Okay, Pat Tabor, we're going to wait just about 15 seconds to give everybody who is attending our webinar here a chance to join and get their screens caught up. And I've almost done that just by bridging this time by talking. So, so I think we can begin. So welcome everyone to the first America Outdoors webinar of 2021. We're very excited to have Pat Tabor with Swan Mountain Consulting back once again, joining us to help you maximize your Paycheck Protection Program fund allotment, help you navigate Payroll Protection Program second draw. And I will just say briefly, you're welcome to post any questions that you have in the questions box. I'll be keeping an eye on that and posing those to Pat. You're welcome to raise your hand if you'd like to be on screen and ask a question in real life. And you're welcome to use the chat box too to communicate any information that you'd like. But I'm not here to talk, I'm here to listen, and very pleased that Pat could make some time once more for our industry to weather this last round of pandemic. So Pat, I'll turn it over to you, and I look forward to your presentation.
Thank you, Aaron, and either good morning or good afternoon, depending on where you guys are at in the country. Happy to be back with you, especially under these circumstances, a little less feeling like the gun's to our head and we're in a survival mode, and now it's more about taking advantage of opportunities. I was just explaining to Aaron and Hillary, you know, we maybe could have done this a couple weeks ago. I thought everybody was somewhat on top of this, and I've come to find out in the last couple of weeks through the inquiries that come through me that there's a lot of missed opportunity happening right now, and that bums me out because I want so much for everybody in this industry to truly take advantage of the kind of the cool things that are available. So what we'll do is we'll go through the, you may recall under the old administration, it was passed on the 27th of December, the economic aid to hard hit small businesses, nonprofits, and venues, or otherwise known as the Economic Aid Act. So we'll go through some of the highlights of that. And then we'll talk about a little known fact that you can actually resubmit your first loan. Folks don't realize that. They think it's really just focused on PPP2. But there is an opportunity for PPP1. And I even got a question just yesterday from an outfitter that said, you know, we just didn't get our act together and everything else. We missed the window. Can I still do a PPP1? And the answer is absolutely. We will go into PPP2 and whether or not you do qualify and some of the nuances on that. And probably the most significant thing is I want to talk about the employee retention tax credit. You may recall in the prior year, there was a handful of members that were really excited about it, but the real killer deal based on the CARES Act was it wasn't really usable. You had to choose between PPP or ERTC, and now you don't. You can use them in conjunction with each other. And that creates a tremendous opportunity for several of the outdoor recreation companies that are part of, you know, American Outdoors and other organizations. And then I'll just cover a few more things. In the past, we usually have people start to add later and later, and then when the questions hit, there's this pent up demand because everybody's got their specific question. I have literally cleared my day for this, and so it's up to Aaron when he wants to cut it off. But once I get through the material, we'll just keep firing away until Aaron says he's got to go eat dinner or something. So with that, I'll jump in. So the EAA had some really cool elements. First of all, it created a modification to the first draw. And what it really allows you to do is consolidate all the guidance that ever came out since April of last year, all the way up through till January 7th, and apply all of that methodology to your PPP1 loan. And the end result of that is if you recast that original loan, you can get more money. So, and I'll get into details of that. Like I said before, if you didn't do PPP1, you can still do it. You can absolutely do it. They did create Triple P2, and they call that second draw. I'll get into some of the acronyms because it gets super confusing. But Triple P2 has some very specific guidelines relative to whether you can or can't qualify for it. They did eliminate the need to pay back the $10,000 idle grant. So for those of you that did original forgiveness quite early, they took that $10,000 off the top. Well, they did away with that with the EAA. And they materially opened up the use of the Employee Retention Tax Credit, or what we call the ERTC. And then finally, and this was probably the most significant thing for a lot of us, they memorialized in the law not only the non-taxability of Triple P forgiveness, but they also shut down the IRS's efforts to exclude the deductions supporting Triple P from being deducted on your tax return, which is a backhanded way of just trying to tax you. So now 100% of this thing that you get forgiven has no tax consequences whatsoever, and that is absolutely massive. In the EAA, they created what is essentially a new definition of seasonal, and you only have to meet one of the two criteria. The first one is does not operate for more than 7 months in a calendar year. And the really key word there is operate. So because if you do bookings and if you receive deposits and you work a little bit in the off season on the maintenance of your equipment, that's not considered operating. And so this is a definition that most people can meet. Because not everybody can meet the second definition. Now, the second definition, and I actually have an example of it, has you take your 12 months and then compute each month. Just pick your 6 lowest months. They do not have to be sequential. And if the sum of those 6 months is 33% or less of gross receipts, then you qualify under the other manner of determining whether you're seasonal. So by doing that, it determines the maximum loan amount, and it allows you to take essentially any 12-week period from February 15th of 2019 all the way through to 2020. The reason that's so significant is you may recall when we were doing iterations of the CARES Act, myself, Aaron, others worked really hard through senators like Senator Daines and others to try to get better measurements for the seasonal people. And the folks we kind of left behind and always felt bad about this is that older definition had the cutoff for seasonal wage measurement through September. So if you were a heavy fall operator, like a hunting and fishing operation in the fall, or our heliskiers, or any of those people like that, they're the ones that really didn't get included in this. And this new opening by EAA creates the opportunity for those people to go back and recast the payroll, and that's what's really significant. And I got a very vibrant example of that I'll share with you in a little bit. So here's an example of that 6-month seasonal computation. Hopefully you can read this. If you're an old fart like me, you'll have to lean in. But you'll notice here that April, May, July, October, November, and December were the 6 most lowest months. Add those all up, divide it by the total revenue for the year, and you get 32.6. Because it's under 33.3, boom, they qualify.
I'm gonna just jump in here for a second and let people know that if they want to expand their window, they have that power just by adjusting the bar there between it. So if any of this language is if anything that Pat's got here is too small to see, you should be able to enlarge that screen enough to see it.
Thanks for that, Aaron. And one of the other things, like we always do, is we're not only going to post this presentation, but I got a number of other tools that we'll put up on the AO website as well, so that you have all of what I've got, you got
Right.
by the tail end of this presentation. So there is some pretty confusing nomenclature, and I run into this a lot when talking to bankers and all that. First question is Triple P P2 and second draw the same thing? Yeah, it is. But a lot of people confuse second draw against your first loan. So if you have a first loan, do you do a second draw of the first loan, or is it a first loan amendment or revision? So you have to be super clear with the bankers, because anytime they hear second draw, they're immediately thinking that what you're talking about is triple P2, and that comes later. If you're trying to go back and get more out of triple P1, you got to make sure that they understand what you're talking about. And there is a very specific order to do this. There's an important clause in EAA that says that you have to have spent all the proceeds from triple P1 before you're eligible to take triple P2. So if you're going to go back and do a draw on triple P1, you got to revise the application, they submit it, you get the funding. As soon as you get the funding, there is a presumption that the money's already been spent on a look back perspective, because it's historical. So assuming you have enough wages and other qualifying expenses to get you to the 40%, you've already spent the money. And I've had that particular argument with no less than 6 financial institutions, because they say, no, you have to spend the money right now. And it's like, no, you don't have to spend the money right now. It doesn't say that. You just had to have spent it on its intended purpose. So the best way to explain that would be to say, I use my line of credit, so I've already paid the expenses, so this is going to relief of my line of credit. And there's really virtually nothing they can do to push back on that. There is a particular form, and I'll make sure that it gets posted on the website, that is in fact a revision of triple P1. I will tell you that there's still a lot of confusion out there. I've been on the phone in the last month with several different bankers and the applicant, and I have to explain to the banker how to read the IFR or something else, because they're just not getting the kind of guidance that they seem to get earlier. So you're going to have to coach your bank. You may even have to consider switching banks. I had another client of mine who was getting a lot of pushback, and I said, you know what, just drop them and go someplace else. He did that. He got approval in a day, and off to the races he was. So let's talk about the specifics of modifying your first draw. You're eligible to increase it because they're consolidating all the guidance. So there's definitional elements now to computing gross payroll that were absent or precluded in earlier guidance. And a good example is work comp. So workers' comp is a disability insurance. Okay, that's what it is. And disability insurance is expressly permitted in the EAA. So if you didn't get to add work comp the first go around, guess what? You get to add it this time, and that can be a material addition. There's a number of other little nuance type things. Plus, we have a much more liberal period, which aids seasonal outdoor recreation companies. And so both by how you measure the period that qualifies and picking the best one for you, plus what you add to it, it seemingly almost always results in a bigger amount of a loan than what you originally got, especially for some of you that were pretty hasty in getting it in, and maybe didn't have the benefit of knowing all the nuances, and you left a little bit of money on the table. Now is the opportunity to maybe go back and recapture that. They did add a number of other employee benefits. In fact, if anything is deemed an employee benefit, you get to throw it in there. So this includes dental, parking, childcare, flex spending, cafeteria plans. Load it up. Like I said, it's better to put it in there and get somebody to nix it than it is to not include it in the first place because you're interpreting it. I was working with a bookkeeper just a couple of days ago, and she said, well, I didn't put healthcare in it because it's not for the employees. Nowhere does it say that it has to be for the employees specifically. This is a healthcare plan paid by the company for the owners. They're the only ones that qualify because they're the only ones that meet the criteria. That is includable for purposes of computing the overall base. So like I said, work comp's in there. And this time around, do not forget your tips. So we're a service industry, and these folks earn tips, and you do not have to have reported it through payroll in order to include it in your overall gross computation. The singular best way to document this is to list the names of the people that work for each pay period, and on a spreadsheet, just start accumulating an estimate how each one of them made in cash tips. You come up with a total and you add those totals to your quarterly, or excuse me, your every 2 week or every monthly payroll, and that's how you get to gross payroll inclusive of tips. So this is a live example. I pulled the name, obviously, of the client, but we recasted their payroll cost computation, got it to the monthly, times it by 2.5. The new maximum loan calculation was $264,000. Their original triple P, they got $66,700. So these folks get to go for $198,000 to go back to triple P1, plus, assuming they qualify for triple P2, which we'll cover, they get an additional $264,000. So we're looking at close to almost $500,000 of proceeds that this company, who's an outfitter, can get. It's a pretty significant outcome. So just a few thoughts on first draw before I move on to triple P2. You get to compute your best 3 months. It doesn't have to be what you first used. So if you recast it under the new rules of seasonality and all that, don't think you have to go back and use that same 3 months. You can use any 3 months that is beneficial to you. There are, again, regional, both SBA offices and banks that push back on stuff. The best thing you can do on work comp is just simply don't call it work comp. Call it disability insurance, because that is a fact. That's what it is. Tips do not have to be reported through payroll. And I really tried to emphasize that, because a lot of people only included the occasional credit card tip that's added to it by the customer. Most everybody receives cash tips. You get to include that in the computation. And finally, and I don't have the time to cover all this because I'm assuming the vast majority of the attendees are business entities, but EAA opened up just a plethora of opportunity for independent contractors, for pass-through entities like a sole member LLC or subchapter S. Nonprofits have the opportunity. So I know in the case of Montana, the Montana Outfitters and Guides Association has completely availed themselves of this. I believe AO has as well. And if you're involved as a trustee or board member for any nonprofit, you should look at this. And then finally, it's super important. You know, one of our lines of business is fishing, and the fishing outfitter model often lends itself to independent contractors. They provide the boat, their rig. You make the reservation, they take the folks out on the river. So you have all those independent contractor workforce out there. Make sure they're aware of this, because there's some money to be had by those small entities. And oh, by the way, for smaller loans, there is a priority that has been given out of EAA to get those folks, and they've streamlined the process. It would be the equivalent of filing an EZ tax return or 1040. So I'm going to leave triple P1 for second, or additional draw on triple P1, and move on to triple P2. So same deal. The maximum loan amount is 2.5 times the average monthly of 19 or 20. So this is interesting. You could use 20 if it's more beneficial. And I had an outfitter that had that exact scenario. Their best payroll period wound up being 3 months in 2020 compared to 2019, even though their overall sales was down. So they used 20 to compute their triple P2. Now, some of you, outdoor recreation companies, always misspell that. It's supposed to be ORC, but I always put OCR. I think I'm dyslexic or something. But some of you qualify for 3.5 time multiplier, and that has been afforded to anybody that's got an NAICS code of 72. Dude ranches, guest ranches often qualify for this. Some of the campgrounds do. It depends on how you're coded, but you should look at that code, because if you have it, like I have a buddy, a colleague that runs a dude ranch up in Montana, and he had 72 on it. He got 3.5 time multiplier instead of 2.5 time. Now, if you previously received a first draw PPP loan or will, it has to be used, the full amount has to be used for all the authorized uses. And so because like I said, those expenses were already incurred and you probably paid them via a line of credit or something, you can claim that they in fact have exhausted all the PPP1 funds. Now, the key element to this program, PPP2, is you have to demonstrate that you had a 25% reduction in gross receipts between comparable quarters in 2019 and 2020. So it looks like this. You take the 4 quarters of revenue and compare it, and if one of the 4 quarters, what's interesting with this company is look at the 4th quarter. They had a stellar 4th quarter, 65% increase in revenue, but they had a 50% decrease back in Q2, which is when the pandemic first started. So this organization, even though it's arguable that they had a great year because in all, they had more sales in 2020 than in 2019, because they had 1 quarter that was off in excess of 25%, they qualify for PPP2 and they can go get those funds, which is pretty slick. One of the things in talking to regional SB offices and banks that I have learned is there are quite a few companies that aren't meeting this test. And that's one of the reasons why there isn't as much drawdown in the proceeds created by EAA this go around than there are previous versions of PPP.
Pat, while we're on the topic, before we jump, somebody in the question panel asked if you said you could use your highest 3 months in 2019 to determine your draw amount. Just clarifying that.
For PPP2?
Yeah, I think
answer
so.
Is yes. You get to pick the best 3 months in either 19 or 20 for PPP2. That's the real effectiveness of PPP2. As long as you met the 25% quarter down requirement. That's the biggie. You got to start with that, because if you don't have that, then you don't get to proceed with anything.
Great. You have to at least demonstrate that if for 1 quarter you were 25% down, but for the loan determination amount, you pick your highest 3-month period.
Yep, for a long span of time. You get to look at many months. So on some of these that I've prepared for people, we are literally starting from February 15th of 19 and rolling it all the way through 2020 and picking the highest 3 months we could possibly find and computing it off of that. Some cases it's 19, most cases it is because of what happened in 20. But like I said, there's occasions where 20 can actually be higher.
Okay. I might
so let's go on to ERT.
To figure this out.
Oh, I'm sorry. You got some more?
I do, but I need to figure it out on the back end. So you carry on, Pat. Okay.
And we'll have plenty of time for questions, so don't worry. And as in the past, if for whatever reason we don't get your question, I'm going to be available to you guys. I want to make sure that you know what you're dealing with. So what is ERTC? This starts to get a little bit more technical, and a lot of people push away because of that. And I think that's a shame because it's a huge opportunity. What it is, it's a refundable payroll tax credit. It was originally created by the CARES Act. And back then, 50% of the payroll-related cost over the eligible period gave you the opportunity for a credit up to $5,000 per employee. So if you have 20 employees, you're looking at 100 grand. So prior to that enactment of the EAA on the 27th, the employer couldn't use this and then also get a PPP loan. And it seemed like there was more dollars in PPP, so pretty much everybody just turned their back on ERTC and didn't even give it much thought. I heard about an entity or two out there that thought it was better for them, and that's probably because they got boxed in on some bad periods to measure, and they couldn't get the multiplier effect on their payroll they wanted to, so ERTC became the better alternative. The neat thing is EAA has expanded ERTC into 21 for one thing, and made several different changes, the most significant of which is that you can have a triple P loan and also use the ERTC. And you can even do that retroactively into last year, which is huge. And it expanded the definition of small employers. And so there were a couple of our larger members of American Outdoors that thought, well, again, I'm screwed because, you know, I in fact do have more than 100 employees. It moved it up to 500. It increased the credit for qualifying wages from 50 to 70%. And then in 2021, it bumped the credit up to $7,000. So this, I'm telling you, this is really worth looking at. What that means is, depending on if you get triple P2 or not, you could, for the first and second quarters, take $7,000 per employee per quarter for $14,000 worth of tax credit per employee for the first 6 months of 2021. Quite significant. A couple other things about it. This is where people get wrapped around the axle, is you have to meet one of two tests. They don't have to meet both. So the first thing they describe is the company must have been fully or partially impacted by government orders implemented to mitigate the spread of COVID-19. This is very subjective, very subjective. And again, I tend to advocate for companies and for the taxpayer. And when you have this much interpretation in something, you have a lot of latitude. The second one, and this is the one that really was significant, and people said, oh, I can't meet that, so I'm done. You had to have a significant decline in gross receipts for a quarter, 50%. That's huge. And they've lightened up going into 2020, but quite honestly, I hadn't found a company that actually met the criteria under 2, and that's why most people just dismissed ERTC as quickly as they were considering it. But I'm here to tell you, forget about 2, focus on 1, because 1, there's all sorts of criteria for being able to qualify. So by way of example, this is pulled right out of the, incidentally, I refer all the time to what's called the IFR. The IFR stands for the interim final rules. IFR, interim final rules. It's an 85-page document that was produced on January 7th. We're going to post it to the AO website. They have superb guidance in that, and that is the definitive guidance, because it's interim final rules. That's what everybody's pointing to when they need an assessment. And I've pointed several banks and say, it says right on the IFR, page 35, line 7, and they look at it and they say, you're right, and so we'll comply. So make sure you are familiar with that document before you headlong into this. That way you can steer the people that are supposed to be helping you in the right direction. This is right out of the IFR. Do I have to physically shut down locations to be considered impacted by the government's order? No, it's a common misconception that a company must be fully shut down to be considered impacted by a government order. To determine if a company is eligible for ERTC, we would consider a partial or full impact to a government order. This may be straightforward for a business that was not allowed to be open for a period of time under state or local order. In many instances, however, you should consider if operational hours were limited due to a government order, or if your business was impacted by your suppliers, or suspending business partially or full to government supply chain. So when I think about it, if social distancing created an issue, if you had to cut down on your trip size, if you had to run more trips because you couldn't take as many people, if you had to employ more buses because you had to social distance on the bus, these are all impacts. And guess what? Once you can articulate an impact, you qualify. It's just that simple. You do have to build up a good, reasonable argument for this. It has to be defendable, but there's a lot of latitude in here. So I really encourage you to get creative. So how do you do an ERTC? Well, it's all claimed as a tax credit through the IRS Form 941. You may or may not be familiar with that. That is the quarterly payroll tax return. So it requires filing amended returns if for 2020, because I assume you've already filed all your 2020 941s. If you, for your upcoming quarter, because we have a quarter ending March 31st, and then you have to file your 941 in April, consider that in conjunction with your triple P2 draw. Make sure you don't overlap them, and we'll go into overlapping in just a second. So if you use a payroll service or a bookkeeper or a CPA, this is pretty easy. You just need to go back and work with them. If you do this yourself, though, this does get a little tedious, and you might want to consider hiring somebody to help you on that. A big confusion about this is it has nothing to do with how much income you did or didn't make. So some people showed a loss, and they think, well, this doesn't do me any good anyway because I didn't pay taxes. It has nothing to do with income tax. This is a tax credit for payroll purposes. So let's just say that you lost $100,000 last year. You go back and recast your eligibility for ERTC and determine that 3 out of the 4 quarters you get to do it, and you accumulate somewhere in the neighborhood of about, you know, $60,000, $70,000, $80,000 worth of tax credits. They will first look at what you paid in the system, and if you overpaid, you get a check. You get money back, and that's why it's so significant. So the big issue here is PPP and forgiveness, and I have always advocated for do not file for forgiveness until you absolutely have to, and then we got people that go do it anyway. And those that have filed for forgiveness, I'm sorry, you cut your nose off beside your face. I'm glad you feel that good that you did that, but the reality is don't file for forgiveness until all of this is done, because the rules just keep changing. So the IRS just literally issued a notice last week, and it provides an employer that received a PPP loan is deemed to have elected not to take the employee retention tax credit for the amount of payroll costs reported on PPP forgiveness application up to but not exceeding the minimum amount of payroll costs sufficient to support the PPP loan. So by way of example, let's just say for a quarter, in order for you to qualify for PPP, you had $250,000 worth of payroll, but you only needed $150,000 of payroll for forgiveness calculation purposes to get up to your 60%. Then that means the other $100,000 qualifies for ERTC. So you can have a quarter that you are doing both, proving up for the 60% portion for forgiveness and also qualifying for ERTC. So now it gets to be kind of a clever game. I had a lot of people say, you know what, I get to the, over the 24 weeks, I get to the 100% of my loan balance just using payroll. So I'm going to make it easy on myself. I'm not even going to bother with interest and rent and all that stuff. I'm just going to report 100% of my payroll. Right now, I will tell you, don't do that. Maximize the 40%. Why? Because you're minimizing the amount of payroll. Why do you want to minimize the amount of payroll for forgiveness? Because then you free up amounts to qualify for ERTC. And that's huge. It's absolutely huge, especially for some of you bigger shops. So I got an example. ORC had a $200,000 PPP loan and reported $250,000 of eligible payroll costs in its forgiveness application. And out of that $200,000, which makes up the forgiveness, the $50,000 that exceeds the forgiveness amount is eligible for the employee retention credit. But if you haven't filed forgiveness and you can jimmy around, look at the very bottom there. If you maximize, if you only go up to the amount necessary for the $200,000, you can actually get more amounts eligible for employee retention credit. And that's again, I think pretty significant. So what's the takeaway of this thing? Consider employee retention tax credit in conjunction with your filing for forgiveness so you can maximize both.
So Pat, if an operator can show that they had to reduce the number of guests in their boats to accommodate social distancing, that would allow them to be eligible for the employee retention. The
Absolutely, absolutely. Because what the argument there is, that is a modification to your business model that was necessitated by a government order. You wouldn't do that for any other reason than the guidelines that came out from the CDC. So when you think about the impact on supply chain, when you think about how it affected your vendors and the timing of things, when you think about all the different procedures that had to be applied, is there any business that didn't get affected? Now, there is this concept of some type of measurement, and some people are saying you have to kind of somehow or another quantify the impact. But the definition, I'll go back up here. Let's see here. Must be partially impacted to mitigate 2019. So that impact, what would anybody reasonable consider to be impact? They're saying about 10% impact. So if you can point to the fact that, let's say in that case, the rafts, it had more than a 10% impact, then it's absolutely at an impact and you qualify without ever having to worry about the 50% test.
Great.
Any other questions on that before I wrap up these last few slides, Aaron?
Continue on. I think most of the questions are around second draw that I'm seeing.
Okay. So just a few more items. This all ends on March 31st, but there's still time. In the last week alone, when people have reached out to me, we settle into what they're going to use. They apply, and within 24 hours are getting approval, and they usually get funding anywhere between a maximum of 10 days, but most of them are getting it within 5. So there's enough time to get both of them done, but do it today. Don't wait till the 28th of March because you're not going to get it through. As I've tried to emphasize before, do not be in a hurry for forgiveness. Let it all shake out. It doesn't matter right now. You don't have to pay a dime on it. Don't be in a hurry. Let it shake out. So the toolkit we're going to load up on the AO site is the full IFRs from January 7th, 85-page PDF document. And then what I've done is I've extracted from that really pertinent guidance relative to triple P1 and triple P2 that's spot on for seasonal. I'll save you the time and agony of searching for it. I've found some of the more significant provisions that affect outdoor recreation companies. I'm also providing you a template. It's called the Sample Outdoor Recreation Company Payroll Computation New Rules Excel template. So on there, you'll see an example of computing the 6 months as a percentage of overall. You'll see the example I showed on the screen for 25%, and you'll see the computation of recasting triple P1. Obviously, you'll get today's presentation. I will say that the SBA site has, in fact, greatly improved. So this URL that's on the website takes you to the landing spot where all things triple P are indicated. It's actually pretty doggone good. I've gotten some excellent information directly off the website without having to go to the IFR. And then finally, we'll take questions now, but here's my contact details. You can drop me an email, send me a text. And with that, Aaron, I am available throughout the rest of today and tomorrow. We'll just keep taking questions till we've exhausted these folks.
All right, well, they're starting to pop, so I'll start to work through these, and we'll start, I think, with second draw questions, and some are popping on the is it the ERTC, so we'll sort of take them in sequence like that.
Great.
Hopefully, well, these are pretty straightforward. So Tim Thornton is asking, can you use the same 3-month period, like in his case, June to August 2019, that was used for PPP1 for PPP2, or do you have to go to a different 3-month period?
You can absolutely use the same period, and the only thing I would ask you is that the best period you can use for all the ones that are available to you? The answer is yes, use it. The answer is no, there's actually 3 months that's superior or higher, well then use the better number. But
Great.
Using the 3 months that you had last year is not last go around is not a requirement.
Gotcha. Great. So if you've already applied for second draw, can you still resubmit for the original Paycheck Protection Program?
Depends on the bank. What I've had a couple of people do is if you had the approval, you can stall the funding. This is a little tricky, and again, it takes a very cooperative banker to do this. They'll let you go ahead and submit. And I will tell you that this is exactly what my family company did. We were really worried about how much funds were going to be available, and the bigger number, of course, was triple P2. But I had computed a recasting under triple P1, and we found an additional $35,000. So what I did is I prepared my triple P2 application and had it all ready to go. Then I did my triple P1 application. The minute everything opened up, you might recall that there was, just like previous ones, they made everything eligible. I think it was on February 13th, I want to say was the date. We went ahead and executed on the triple P2. It got approved, but then we put a stall on it. And then we went ahead and filed triple P1, got the proceeds, spent it because we paid back our line of credit, turned around and filed triple P2, and 5 days later got the proceeds for that as well.
Wow.
But you know, we're in go time now, so it wouldn't surprise me. You guys got to do the calculation. Wouldn't surprise me that if you didn't leave that much on the table, your bank probably will tell you, look, I know you'd like to have both, but we're a little uncomfortable with that. Why don't you just go for triple P2, assuming you qualify, and we'll call it good. That's still an okay outcome. If you have 100% filed and received your cash from triple P2, I'm not sure anything can be done in that case, quite honestly.
Right. Yeah, but if you haven't received the cash, you can ask the bank to put a hold on that and go for PPP1.
Absolutely. That's the way to handle that.
If folks have already gotten forgiveness for PPP1, can they still resubmit for PPP1?
Nope. That was the real negative drawback of applying for early forgiveness, is that you cut off your opportunity to go back to triple P1. So forget about triple P1 and put all your energy in triple P2, because for all intents and purposes, triple P1 is done for you because you filed for forgiveness.
This is why
now, if you haven't received forgiveness yet, if you have not received it, you can withdraw the application for forgiveness. So I have a client that just did that this week. They put in for it, but there's a massive backlog on forgiveness right now because, quite frankly, they don't care. They're still focused on triple P2 and first draw. So if you filed it and have heard nothing, you can withdraw it and then maybe go back into the well. But if you've already received a letter of notice of forgiveness, nothing anybody can do for you.
Okay. And so if people are going for PPP2, does that money have to be spent on the same payroll and expense guidelines to qualify for forgiveness?
No. So in fact, it's necessarily different. So the measurement period for forgiveness, and I want to tell you right now that we don't have any of the guidance for triple P2 forgiveness. The only thing we have to hang our hat on is it can be either an 8 or a 24-week period that gets triggered in a prospective basis. So it starts the day you receive your funds. So if you receive your funds on March 1st in 2021 for triple P2, it's going forward. It has nothing to do with what happened in the past. Triple P1 in second and then a redraw of triple P1 all looks back, but triple P2 looks forward. And if you obviously elect a 24-week period, then you're going out 4 months. Hopefully you're getting into some of your summer months, and which is what you want, obviously. I said 4 months, I meant to say 6 months. So, you know, most of us, if you are just getting around to triple P2 now, you're going to get to pick up your payroll and the other expenses that qualify, by the way, which is vendors. They really upped the game on that 40%. So there should be no problem for you guys to reach forgiveness on triple P2, but that'll be a 2021 event. Has nothing to do with 2020 or triple P1.
Yeah. I think as we were calculating, it looks like if you got it by the end of this month, you would be good through partway through September, maybe the first half of September.
Yeah, and the key for a lot of our summer operators is if we could capture the tail end of June, all of July, all of August, that's usually that wound up being for almost everybody the measurement period that was grabbed in 19 anyway. And so for 21, and then we'll be right back to and we'll probably follow up with a seminar. But once you know your measurement period, you're going to want to move certain expenses into that period and pay them. Like if you have a supplier or people, you can. So I'll give by way of example, we purchase 500,000 tons of hay a year for our horseback operation. Ordinarily, the grower is really quite flexible when we can pay them. And if we want, we could pay for the whole doggone amount in one fell swoop. Well, I can assure you, in order to ensure that we hit the 40% mark for our triple P2, we're going to maximize the amount that we pay to that vendor during that time frame so that we don't leave any money on the table for purposes of forgiveness during that 6-month measurement period.
Smart.
And again, I want to emphasize, just like with triple P1 forgiveness, triple P2 forgiveness, don't use up all your payroll trying to get there. Only get to the 60% and backfill it with the 40% of what you're eligible for. Why? Employee retention tax credits.
Right. All right. Toby Rohrer has been waiting patiently with a question he asked, which I think we saw in an email too, Pat. He's trying to calculate maximum loan amount, taking into consideration his own income and seasonal status. So he inquired with the lender. Yeah, go ahead.
So I ran into a snag with this exact question because I have another client that I work with that is a sole member LLC. He doesn't pay himself any payroll, and he waits to make a distribution to himself at the end of the year. And so the measurement period for purposes of his payroll, he didn't pay himself anything as a pass-through entity. In other words, he didn't take any owner distributions until later at the end of the year. And unfortunately, the bank would not capitulate on that. They wouldn't let him average out. They wouldn't let him do anything. They basically said, no, this is the measurement period. And because this is the measurement period and you didn't make any distributions to yourself during that period, you don't get to include that in your computation of loan proceeds. Now, in the case of triple P1 or 2, you have more flexibility and you may take into account that very thing. If you wait till the end of the year and do a year-end distribution, and therefore up to $100,000 would be included, take that into account. Maybe you wind up using the last 3 months of a quarter in 2020, or for that matter, 2019, so you can get that measurement period up. But it's effectively cash basis, so it's based on whatever you paid during your measurement period for payroll. So in Toby's case, I think unfortunately, the bank has already ruled they're not going to capitulate on that, and I haven't been able to get another bank to do it either. So it's unfortunate, but that's one of the fallouts of how everybody's interpreting this right now.
So it's regardless of what the timing is on how you pay yourself as an owner or how you pay a partner, that you can't use that as part of your PPP calculation. Am I understanding that?
It's actually not regardless of, it's with regards to. So it's the other way around, Aaron. So it really matters what time you paid yourself in conjunction with what period you're measuring for purposes of qualifying for PPP. So let's just say that your best payroll periods were July, August, and September, but you made your distribution as a pass-through entity, subchapter S or LLC in December, because you didn't make that distribution in that 3-month period that you were measuring, you don't get to include it in there. You only get to include what you paid during that period. And that's the way they're achieving it, which is really frustrating because they don't do that with any of the other expenses. You're allowed to create monthly averages for healthcare, for all the employee benefits and everything else, and add those in, but only for employee draws. So what they did is they fixed the problem with basically sole operators. They fixed that perfectly because the sole operator doesn't have payroll. He just basically collects whatever he has at the end of his year off his Schedule C or LLC or whatever, and he doesn't incur payroll taxes. And so they created a special application for that individual. And of course, they very readily have handled employers that have multiple employees and you can report, and they've improved seasonality. What they didn't do was a good blend between a sole owner or sole member scenario where you're getting distributions and combine that with quarterly payroll reporting. They didn't fix that problem, and there's several of you that are running up against that, and I wish I could tell you I have a fix for it, but I don't. I heard of one guy that cleverly argued his position, and the bank went ahead and submitted it. It got approved, but guess what? He got away with it, is what it sounds like. And if your bank has already told you no, there's nothing I can provide you that will override that, unfortunately.
Okay, well, thanks at least for that explanation. That's insightful. So Cole Banger, I hope I'm saying your name right, has his hand up and he has a few questions. I'm going to try to unmute him and invite him into this conversation to see if we can address his thoughts and concerns. So let me see, Cole. I think you might have to unself-mute yourself. There you are.
I unmuted. Can you hear me?
Yes, we can.
Okay. Hey guys, how are you?
Good. How's it going, Cole?
Good. I did have my hand up, but I don't think I meant to. But so anyway, I'll ask the question anyway. So we were funded for PPP1 and got it totally forgiven, and it was 100% payroll because it was just easy for us to do it that way. We've since been funded by PPP2, and so does that dynamic eliminate us from qualifying for ERC, or are we still able to qualify?
It does not, and you're not even out. You're not even totally screwed for 2020. So not knowing the numbers, you can work up to your measurement period for forgiveness and after your measurement period for forgiveness. So a lot of people qualify in their fourth quarter because their 24-week measurement for forgiveness ended somewhere in the September timeframe, in the early weeks of September, maybe October, depending on when they filed. So anything in the remainder of 2020 or anything leading up to prior to you taking forgiveness is eligible for ERTC. Now for Triple P2, because it hasn't even started yet, we haven't even gotten to forgiveness or any of that, you're in the driver's seat of planning around this. So the first recommendation, of course, is don't take the easy way out. I get why you did that because it was super convenient and made the application a lot easier. But don't do that this time because you'll leave money on the table. And this year it's $7,000 per employee per quarter instead of $5,000. So what I would do is cleverly compare and contrast your payroll and how you can maximize credits in conjunction with making sure you achieve forgiveness. You're going to have to do several iterations with and without. It's like a massive math exercise, but you're trying to be strategic about how to maximize the benefits of both programs in conjunction with each other. And because it's Triple P2 and we're looking forward, you're in the driver's seat to do that. So this time, Cole, maximize the 40%, which reduces the total amount of Triple P2 forgiveness elements that are allocable to payroll. Why are you doing that? So you can maximize however much is left over to qualify for ERTC. And it's still worth going back and looking at 20 for what's left over to see if you can salvage anything out of 2020.
Do that. Thanks.
Thank you, Cole. So we're going to talk a little bit about forgiveness now. Josh Goldback asks, well, he mentions that they have applied for and received a second draw. The eligibility requirements state that all funds have to be used on eligible expenses. What if you don't achieve full forgiveness on your first loan? How does that affect second draw forgiveness? Would they say that you're not eligible at all post hoc, he asks.
The two are unrelated. So first of all, it would be almost inconceivable that you couldn't qualify for PPP1 forgiveness, because like I said before, the IFRs consolidated all the guidance. You're now going to 60-40 instead of the original 75-25. And if you throw in all the extra things you get to throw in there, and you use a 24-week measurement period, for the life of me, I can't figure out how anybody wouldn't qualify for forgiveness on PPP1. PPP2, again, is looking forward, not backwards. So we don't even know, we don't even have the guidelines specific to the details for the forgiveness program, and the applications for forgiveness of PPP2 won't come probably till the summer. They're just not in a hurry. So don't fret right now about forgiveness on PPP2, other than what I've discussed with the employee retention tax credit. Try as best as possible not to use up all your payroll in trying to get to forgiveness. Now, if you can't get there any other way and you have to use your payroll, that's something different. But if you can just get up to the 60% on your payroll and get the 40% with all the other qualifying expenses, that's the way to go so that you can maximize the ERTC. So I think maybe I answered that question.
Yeah, I think he's just concerned that because they didn't get full forgiveness, they just automatically they're concerned they automatically wouldn't qualify for a second draw.
No, that's just not the case. The two have no relationship to each other at all.
Okay. All right. Poking around here a little bit more. If you already submitted your forgiveness on PPP1, oh, this is an answer. Well, let's just confirm it. Scott Dugan says if you already submitted forgiveness on PPP1, you cannot use the employee retention tax credit for 2020 on the payroll above the forgiveness amount you received.
That's not correct. That is not correct. It directly out of the IRS, the IRS guidelines. So if you achieve forgiveness for 200,000 out of 300,000, then the 100,000 above and beyond the 200,000 that was included in forgiveness is eligible for ERTC, straight out of the IRS guidelines. 100%.
So if you submit payroll for forgiveness, but it's not forgiven, you can use that remainder amount for ERTC in 2020.
No, in either case. So if you submit for forgiveness and you achieve forgiveness, and what was forgiven was $200,000 out of the 300,000 that you incurred during a period, then the amount that wasn't needed for forgiveness, because you only needed 200,000 and you had 300,000. So the difference between the two, which is 100,000, that 100,000 is eligible for ERTC. If you used up 100% of your payroll, then absolutely. If you've already applied for forgiveness and you used it all up for a period, let's say of July 1st through October 1st for the 24 weeks, then you have blocked out that period and none of that payroll is eligible because you used it all. But perhaps look to prior to July 1st and definitely look after October 1st, because the forgiveness period only covered a specific 24-week period, and all the payroll prior to and after that during 20 does qualify for ERTC.
Great. Yep. I'm glad we addressed that.
Yeah, this is so nuanced that you really have to go through iterations on that. But that was kind of the most significant thing about the IRS guidance that came out last week, was this tolerance of and acceptance of the fact that you could actually double dip in the same quarter if you didn't use everything for forgiveness.
Yeah, great. And so following up on something else Scott asks, could you address the PPP-1 forgiveness? What is the likelihood that the bank or SBA will request documentation on your forgiveness application? Do you have any experience with this and what to expect with the process?
So one of the things that the EAA addressed, and one of the things that we've heard a lot in industry, is pretty much everything under 2 million just isn't going to be focused on much unless there's just something terribly egregious about it. Now, there's nothing in writing, there's no guarantee on that. Obviously, you know that if you had a loan of 150,000 or less, they're just, I mean, there's an easy form and they're just waving their hand. You don't have to have anything. For amounts greater than that, but under 2 million, you're in the zone where the majority of applicants are, and there's less interest in trying to audit all those. The amount of documentation that you have to have was all part of your original application, and will be again on Triple P2. So it indicates right in the body of your agreement what information you have to have in your records that constitutes backup for whatever you put in your application. Obviously, for payroll, it's going to wind up being your 941s or other payroll records that you maintain. If you did some computations, like in the way of tips, they're going to want to see your computational spreadsheet or whatever else, whatever supporting documents there are. Then it's like anything else. It'd be just like filing a tax return. Then you do it, you go through the process, and you wait. And you may never hear another word from anybody, or you may get randomly selected for an audit. Or maybe there's something in your deal that really triggers something and you get contacted. But what I can tell you from a resource standpoint, they don't have enough resources to audit all the Triple P loans out there. I mean, they just don't. And the vast majority of processing that's going on right now for both loan processing by the SBA and forgiveness are all being outsourced under short-term contracts. And once they get through all of that, they'll relieve those people of their duties and they'll go back to the normal size program they were, which means they'll have even less resources to audit people. So there's no prediction. I can't tell you that, oh yeah, you know, you're going to get audited or not. But if you're under 2 million and you got a relatively straightforward application that's kind of the obvious stuff, they're not going to bother coming back and looking for it. The bank doesn't want to do it at all. Bank just wants to get rid of it. So the bank will only do it if they're mandated by the SBA.
I feel like we captured this one. I just want to make sure that Don Roberts, who's asking this question, gets his answer. If you received forgiveness for PPP-1 and already received funding for PPP-2, is there anything we can do? Let's presume that question is around the ERTC for this year. They already got the money, yeah.
State it one more time so I make sure I understand the nuance of this question.
Yeah, so if you have received forgiveness for PPP-1 and already received funding for PPP-2, is there anything we can do?
Yes. There's probably nothing you can do for additional draw on PPP-1. That door is closed to you.
Mm-hmm.
But the door that's still open to you is ERTC for 20 and the proper planning and balance between ERTC and Triple P forgiveness for 21. Those opportunities are still open.
Right.
And oh, by the way, if somehow or another you think maybe you made a mistake on your Triple P2 application because you learned something you could include that you didn't know, you can reapply and get the bigger, better amount under correcting the error for Triple P2. I've had that happen to me 3 times. So I've said, well, did you remember to put in the tips? It's like, oh gosh, no. Did you remember to put work comp? Oh, I didn't have work comp. Well, then reapply and get that money in there. And so
That's perfect.
you know, that you can do, but the only thing for this individual's question that is closed as a result of the filing and granting of forgiveness is triple P1 is done and gone. There's nothing more we can do with triple P1.
That's great because, in fact, Cassie, well, the earlier part of your question, the earlier part of your answer is great. Cassie Baldelli asks if you can revise PPP2 if you calculated it off 2019 and should have done it off 2020. So exactly to your point, it sounds like she can go back and fix that mistake.
Yeah, and in her case, and in a lot of folks, you know, it's always going to be dependent on the attitude of the bank. I know, you know, with their company and the relationship they have with that bank, there's a tremendous amount of flexibility and willingness to work with them. They've been blessed by that, as have we with the community bank that we work with. Not everybody's so lucky. I've worked with people in other jurisdictions where their banks are just, you know, so super conservative. I was on the phone on Monday and it wound up being on the phone with the applicant, my client, and the bank president. And I explained to them that there's nothing in it for a bank to be conservative. They get paid for everything. They're getting paid an origination fee. They have zero risk, and every cost associated with administrating triple P is being reimbursed. We should really rephrase these laws and call them the Bankers Retirement Act, because it has been a massive boon for the banks, which is good. That's a good thing because we want community banks to be solvent and really a part of the solution for economic recovery. But there's zero incentive for a bank to be conservative. So I encourage you to be aggressive and say, look, there are several. So in the case of Cassie, she can say there are several banks in the Flathead that are doing this and have done it readily through the same regional office that you go through. So there's really no excuse for us not to do it because other banks have been doing it and the SBA has been approving it with them. So they're not going to push back on you. It's just a bank policy. And that's the thing you have to decide is, are you butting up against a bank policy or a regional office SBA policy? I've come to find out that a lot of these banks interpret things incorrectly and they memorialize that as a rule, and they got it wrong. They just flat out got it wrong and push back on them if it doesn't sound right.
Yeah, certainly. I remember dealing with some folks who I think they were working with Bank of America that was just not looking at the full definition of seasonality, telling them that they weren't seasonal because they operated throughout the year, even though they met that 66% requirement in 6 months or whatever it is. Yeah,
it's interesting, Aaron. It seems the bigger the bank is, the less flexibility and interest in really advocating for you as their banking client there is. And it's the flexibility and the nimbleness of the community banks that have really been the hallmark of this program, in my opinion.
Yeah. So Cassie also asks, she says, our bank said we had to use 2019 wages for PPP2. So that's what they did. Oh, we answered that question. I might have.
Yep.
I might have answered another question and not cleared this one out. So apologies for that. Let me shoot at another one. We have a couple of questions around the Etrc process specifically. First of all, I'll ask, this is from Rhonda Stallone. We just applied for forgiveness this week. Is there anything we can do to maximize Etrc?
Yeah, so if they applied for forgiveness applicable to triple P1, and if in that process they just used the maximum of payroll, like essentially took the entire balance of their triple P1 and covered it with payroll alone and didn't take advantage of 60/40, then I would withdraw that application immediately. And then go back and analyze the blend between ERTC and triple P forgiveness and maximize the benefits between the two. Now, if you ultimately get to the same conclusion, again, applying for forgiveness gets you nothing. you're not going to have to pay on these loans for quite some time. Everybody's in a hurry for forgiveness, and to what end, I don't know. It doesn't get you anything other than it's off your back, and I guess you can just say I'm done with it. But if you're still trying to maximize the opportunities that keep coming, forgiveness shuts a door for you. So that's what I would do is if they in their application they did the 60-40, then it's okay. Then let that forgiveness go through, but then do the pain and agony, because it's a pain in the butt. You have to get a little accounting oriented to try to decipher wages above and below, the triple P amount. So it's tedious. But I'm telling you, at $5,000 per employee, it's kind of worth it. I even look at the small guys and say, they only got 3 people on payroll. Well, it doesn't take long for those wages to qualify, and that's a check for 15 grand. I don't know, 15 grand is 15 grand. So it seems worth it to me, but that's going to be a different measurement for every recreation company. Some of you are starting to gear up for your upcoming season. I think we anticipate an onslaught like something we've never seen in our lives coming up this year. The pinned up demand is insane. So the last thing you probably want to do is split hairs in accounting. But if the money's worth it to you, do it. If it's not worth it to you, move on.
Great. Yeah. Could you outline for folks the process of the employee retention tax credit application?
Yeah, so there's not an application separate. It's really on the 941, and the best advice I could give you would really be to just go directly to your bookkeeping service, your payroll processing service, or your CPA, assuming that you're getting the payroll done by one of those 3 entities. If you're doing your payroll in-house, then what you're going to have to do is probably call up your CPA that has a payroll division and a payroll specialist and have them walk through you. It's just so beyond what we can do here, on a webinar for me to try to describe that process. But at the end of the day, all you're really doing is resubmitting your 941s and taking advantage of that tax credit, because that's where you apply for it.
That's great. Okay, we have a couple questions around 1099. So these are independent, or maybe one question stated twice. And I think I know the answer to this, but if you have 1099 for employees, can you add that to wages? I think I don't think you can, but I think that those independent contractors can apply for their own payroll protection program. Is that right?
Yeah, you're absolutely correct, Aaron. So they held the line right from the very beginning. There was a 2 to 3 week period back in April when they were first doing CARES, where they were going to allow you to include 1099 as part of your computation in figuring out triple P. They removed that very quickly, and they have replaced it with the concept that you take care of your payrolls and everybody that you got on W-2s, and your independent contractors can be made whole by their individual application for triple P on their end. And what the EAA did, which more so than I've ever seen in this January 7th IFR, is they have really created a super easy pathway for those independent contractor businesses to get some relief through triple P. In fact, they use the term fast track. They're putting emphasis on those applications to get those people money, because the assumption is they're the small ones. I think of our fishing guides that are independent contractors. They have their pickup truck, their boat on a trailer, probably a dog, and their fishing equipment, and they independently provide fishing services for a variety of different outfitters in the area. That's the definition of an independent contractor. That individual, as a sole person, has a super opportunity to go out and get himself some proceeds from triple P. But you, as the person who writes the check to the independent contractor, you're not going to be able to get any benefits for that relationship.
Right. Okay, thank you. We're getting through them here, Pat.
Like I said, I've cleared it out, so I'm here for as long as you can tolerate it.
At this point, we have 3 more questions. They've all fit in my window, so I can see everything that's going wrong. We sort of got at this. I just want to make sure that Toby Rower is covered. He was the person who was asking about paying for his partner, and we were sort of, and we were, you were explaining that if your partner is getting paid outside of that 12-month period, they're not available. Like that's not available. But I think if they are getting paid during that 12-week period of calculation, it is. And so,
absolutely,
yeah, he says, is his non-payroll partner's compensation within the 12-week seasonal period included in the maximum loan amount computation?
And the answer is yes.
Yeah.
So if there are some companies that pay their owner, if you will, in lieu of wages, they make a monthly distribution, let's say, and by giving him cash monthly, then he can turn around and use that cash to pay his personal expenses. And that's a fairly common model if the recreation company is the only source of income for this individual and they do not draw a payroll or a paycheck. Under that circumstance, you're allowed to count those distributions to that individual. In fact, that's one of the major thrusts behind EAA was the pathway for that, but you had to have physically paid it during the measurement period that you're applying for your triple P. If it didn't happen during that time frame, you can't move it over now after the fact. It doesn't work that way. And just recall that there is that $100,000 limitation annually, which means looking at it from a 3-month standpoint, I forget what it is, but it's formulaically, you basically are limited to what would be the equivalent of 100,000 for the year. So I think it's $30-something thousand or something like that. That's the maximum cap. So let's just say they really pay themselves a big chunk of money, and if you annualize the amount that was paid, it would exceed $100,000. Then you don't get to take the full amount. You can only take the pro rata portion that assumes a maximum of 100,000 in a year.
Gotcha. We have a question here from Rhonda Stallone, who asks, if you withdraw your request for forgiveness from PPP-1, can you resubmit it later? Yeah, I think the answer on that one is yes, right? And in fact, your advice is to not rush into that because there's still rulemaking happening.
That's right. Yeah, so if there's an ability to withdraw that application, that doesn't hurt anybody or anything, and it removes the potential lack of eligibility for you to go back and draw additional funds for triple P1. So if you can do it, great. It's going to be up to the bank though to let you know whether they will allow you to withdraw it. It depends on where it is in the cycle, how far gone it is before it can be clawed back.
Thank you. Yeah, that makes sense. So Shelly Cundy has a couple of questions here. So let's get to her. She asks twice around 941s, is there a deadline for adjusting 941s to apply to the employee retention tax credit?
That's a great question. So the answer is no. It's similar to other types of amended tax returns, including income tax returns. You have up to, I believe it is 3 years, a statute of limitations to go back and amend the tax return on new information that you acquired or a mistake that you made. In this case, you're effectively incentivized by EAA to go back and amend returns that were filed when there was a lack of information and understanding as to the applicability of the program. EAA and then the subsequent IRS notice that came out last week specifically empowers folks to now be eligible to go back and amend those 941s and capture any ERTC that they qualified for but didn't take because of the confusion of the guidance at the time. how long that window will be open till really for 2020. I think you'll have all the way out until 2023. And then quarter by quarter, it'll start to expire for being eligible for carryback.
That's great. Thank you. Can you talk a little bit more about estimating tips that are not reported through payroll? This is Shelley again. Do we have to prove these in any way, and is it confirmed that workers' comp is okay to use to calculate?
Yeah, so the way the law reads is a reasonable estimate. So it's again, the usage of language that is subject to interpretation and is very subjective in general. And I've had a couple of banks say, well, I want to see it on the 941. It's like, well, it's not on the 941. And it says right in the rule, it doesn't have to be on the 941. It does not have to be reported tips. So then the question is, well, then how do you come up with this reasonable estimate? And really the answer is in any way reasonable. So what I did for our companies, and I've encouraged others to do it, is we sat down with an Excel spreadsheet. We listed the names of the employees by pay period, and we have a very good sense for what people make because we provide some guidance to clients before they show up, guidelines in terms of a percentage of a trip. Plus, we have enough employees, long-term employees, that share with us how people do and all that. So we have a pretty good sense for it. And what we would do is person by person, we just drop down a dollar amount in each 2-week period over the entire 3-month period, add it all up, and then add it month by month to the gross payroll in that month. And that is our documentation. When you call up the spreadsheet, it's got names on the left-hand side. It's got estimates of what they think they received in the form of cash. It all comes up with totals and gets added to the gross payroll. It could be wrong. It's an estimate, but it's a reasonable estimate. It's our best effort, and that's all the law requires. It's not a bottom line auditable thing.
Right.
And so I will tell you what's kind of interesting is once it's forgiven or you get the proceeds, I know of a number of operators that were taking a portion of the loan that was attributable to that amount, and they were actually giving it to their employees, which is kind of the intent. Whether you do that as an employer or not, that's up to you. But there are several that did that because not only are the employees were out of work or whatever for a period of time, which is painful from a compensation standpoint, but they're also out that tips. And in some of our lines of business, as an industry, the tips are more meaningful than the wage because of the nature of what service they provide. So,
yeah.
But that's how you would compute it. Now, what I cannot tell you is whether your bank will accept that. That varies by financial institution.
How will it affect how will it affect guides and the taxes they pay? For example, would they have to pay back taxes?
Nope, not at all. Because it wasn't reported through you, you have no obligation to report it. All this is an estimate that's being provided for loan calculation purposes. It doesn't get used for any other purpose. So it doesn't get submitted to the IRS. It doesn't get submitted, as part of your payroll package. This is a loan application going through a completely different entity. It is up to each employee's responsibility that they get a wage. And I think we all know in looking at the face of a 1040 that you pick up your W-2, which will include your wages and any tips that were reported through the employer. And then there's a specific line item where the taxpayer has to indicate any additional tips that they received directly from a customer. And so it's their obligation, not the employer's, to pick that up. Now, there are a couple of industries that have some nuance requirements and heavier regulations around it, restaurants and casinos and certain bars. And that rule of reporting may be different on a state-by-state basis. In other words, how the departments of revenues of states, what they require versus what the federal government requires. But in the case of the IRS, you're only required to report what is reported to you.
Understood. So we have Jeff Winslow has his hand up, and I'm trying to send him an audio pin so he can join our conversation. Hopefully you're able to manage that, Jeff. In the meantime, we have a couple more questions to look at, so we'll walk through these and see what else pops up. Otherwise, we might be getting close here. So we have a question around J1 visas. So can you include J1 employees in your payroll amount that you use to reach your eligibility computation? Yeah, for example, his highest payroll in 2019 was in 2019. However, he had J1s, and in 2020 he had no J1s.
Yeah, he can absolutely do that because it's all reportable, right? So he's pulling it off of 941s. Just because they're foreign students, part of the J1 program, he's still required by law to include them in the payroll tax reports and also to issue W-2s in the whole 9 yards. So their inclusion in the loan calculation is a no-brainer. Now, obviously, when you go through the forgiveness calculation, if you have less payroll, that's one of the reasons why they extended it from 8 weeks out to 24 weeks, is because they recognize that a lot of these employers just had fewer people and they weren't going to be able to recoup what they paid in prior years because they didn't have as big of a work staff.
Great. Well, I think that's going to be very beneficial for Scott to know that. So Taylor Angam asks if there's a different form for a PPP2 seasonal payroll calculation, or is it the same form?
So forms, interestingly enough, are a combination of what the SBA provides as overall guidance, but then really what the bank drives. So, just at the beginning of this week, I received a template from a client that he received from his bank, and it had all these tabs on the bottom, and it had a tab that you fill out if you're an employer that's seasonal. It had a tab where if you were a pass-through entity. It had a tab if you were a nonprofit. So that bank had developed different tabs based on what criteria you met. Others have a very standard, almost benign form. So it's more driven by the financial institution that you're working through. A lot of banks have processing centers where they take whatever information gathering tools they use as a bank, and then they have their own people go into the SBA portal and fill out what is effectively the form that's used by the SBA, because the form is a automated form. You fill it in much like a fillable PDF, and then you push submit, and then it prints out a copy. Like for instance, the bank that I utilize in Northwest Montana prints out that copy and has you fill out all the rest of it. There's initials where you got to put on certain affirmative statements, you have to sign the application, all that. But they are the ones that complete all the information in their portal, and then they produce it, and then after the fact, they provide the document, get all the necessary initials and signatures, and then that becomes part of their permanent file. So long-winded way of saying that that's going to depend on the bank. What I think his question is pointing to, though, and this is an issue, is there seems to be a disconnect on this issue of seasonality and then being a sole owner entity, similar to what Toby brought up earlier. There doesn't seem to be a form that accommodates being seasonal and having a pass-through entity. There's a pass-through entity form and there's a seasonal form, but there isn't the marriage of the two. So what I did for one client at the end of last week was I just merged their two forms together and made that his application, and the bank accepted it.
All right. Yeah, got to be creative with this stuff.
Well, that's what I'm thinking.
Taylor, whose question we just answered, mentions this. He said his banker just told him that his deadline was extended from March 31st to May 30th. That just gives me some discomfort. Like, I haven't seen anything come out of the SBA, or isn't it in the law that the March 31st deadline?
I haven't seen anything, but I'm wondering because that the big $1.9 trillion act just passed. I wonder if there's an extension of PPP2 in there. That would be a wonderful thing if it happened. And I was hoping they would do that. The problem is all of my contacts hated the bill, so they weren't going to do anything to improve it. They were hoping it would die, and so a lot of our influences on trying to affect bill language weren't usable this go around to try to influence this latest one that passed. That would be the only reason that I could think that it get extended, because the March 31st is statutory as dictated in EAA. So the only way to get an extension of the March 31st deadline is to have subsequent legislation that extends the due date. So I think your suspicions are correct, Aaron. You better circle back around and find out what authority that bank is quoting for that, because that sounds a little shaky. But wouldn't it be wonderful if they extended it through May 31st? Because then this gun to our head kind of thing between now and March 31st would be relieved, especially the timing of going back for 111 draw, getting it, spending it, and then going to get PPP draw.
Yeah, well, and if you're a fall hunting operation, all of a sudden that 8 to 24 week period can start to capture your October and your November.
That's exactly right. So the longer you can put off taking receipt of PPP2 proceeds, the more opportunity you're going to have for qualifying for forgiveness, because you're starting to roll into your most active period for payroll. Because that's the one flaw about PPP2 is the measurement period doesn't help seasonal outfits very well. Once again.
Yeah, absolutely. Pat, I think we've addressed at least all the questions that I have had in my box, and I know for we've had about half of our attendees drop off here, but we had a good 50 folks at our peak, and we know over 70 people engaged in this. So folks who didn't attend are still going to be able to see that webinar. And as you mentioned, of course, we're going to put this up along with all of the additional resources that you've provided, including this presentation on the COVID-19 page of the America Outdoors website. I just want to thank you for continuing to provide so much support, and to the numerous outfitters that are able to take advantage of your advice. And I mean, I know you've saved many businesses just through your advocacy for the outdoor industry. So I sincerely thank you for that. It's really wonderful to have you here making this this complex legislation understanding to everyone, and you're greatly appreciated. And the thank yous are popping up in questions now too.
Yeah, thank you, Aaron. Appreciate that so much. Really do. And take care out there. Stay safe. I hope everybody has a great year, and look for more follow-up information as we get it. We'll provide it to you guys.
Scott follows up with one more question. So
right.
We'll catch him before we go. He says, can you add your 3 highest months of payroll and combine the amount with your 1099 payroll to come up with the total?
I'm sorry, say that again. There was some background noise and I didn't hear that.
I'm sorry. Can you add your 3 highest months of payroll and combine that amount with your 1099 payroll to come up with a total? I'm trying to understand it as I read it.
Well, so 1099 payroll cannot be included in the computation of gross payroll for purposes of the PPP loan. So if you have what I'm assuming is independent contractor or people you pay via 1099, you statutorily cannot include that in your PPP loan computation. Only those people can go and get their loans themselves through PPP as an independent contractor, but you as the vendor, if you will, or the master purveyor of those contracts do not get to use that in computation of your loan.
That's right. Yeah, that makes sense. I was caught up a little bit in there, but the 1099s, like we said before, are not part of your payroll protection program calculation. They can be part of their own, but not yours. So fantastic. All right. Yeah. Well, I hope we've helped some folks today. I hope folks are able to possibly put off forgiveness a little bit longer and do what they can to maximize their tax credits and maximize the amount of money they can get in PPP2 and possibly even go back for an adjustment on their first draw too. So with your help, yeah, some folks will definitely benefit from this.
Awesome. Have a great day, great weekend, everybody. Thanks, Aaron, for hosting us. Bye-bye.
Yep, absolutely. Take care, Pat. We'll see you again.